Well, a warm welcome everyone and thank you for joining us today. My name's Joel Carty from Solace Financial. Today we have Kurt Livermore from Lazard Asset Management. Kurt is a portfolio manager / analyst from the Lazard Equity Advantage team. He began working in the investment field in 1997. Prior to joining Lazard in 2023, he was a senior quantitative equity portfolio manager with Acadian Asset Management. Previously, Kurt served as a portfolio manager and partner for the US and global equity strategies at Globeflex Capital, and beforehand he was a portfolio manager for US equity market neutral strategies at Front Point Partners and Mikos Capital. Kurt started his career at BGI BlackRock. He has a Bachelor of Science in Business Administration from the University of Arizona, and he's also a CFA charter holder. But before we get stuck into our discussion, I'd like to quickly provide a general advice warning. As we go through today's discussion, we'll be discussing financial information which is general in nature, meaning it doesn't take into account your objectives, financial situation or needs, so it's not a recommendation. It's important that you consider if what we discuss today is appropriate for you before acting on it. Also, please refer to any product disclosure statement regarding the financial product for further information. Details of this general advice warning can also be found at the moneysmart.gov.au website.
Thanks for joining me today, Kurt. To kick things off, as a fund manager, especially a quant fund manager specializing in the global small cap equity space, can you start by giving us a quick overview of Lazard's philosophy in the global small cap space?
Our philosophy in the global small cap space, first and foremost, boils down to wanting to be a consistent manager, meaning we want to have consistent excess returns. From that flows a couple of things. On the alpha side, or the way that we get those returns, it's really about stock picking and stock selection. And then from there, we try to build a portfolio that looks a lot like the benchmark for the major, we call risk factors or macro risk factors. So it's going to look a lot like the benchmark from a country allocation standpoint, a sector allocation standpoint. It's going to be relatively immune to the vagaries of style investing, and so we don't want to do really well in a value market and give it all back in a growth market. And so we construct our whole process really around that goal, to really give investors a consistent return stream and to not be exposed to all these macro risks in the marketplace.
Can you expand more on the investment process and how you identify quality businesses in the small to medium size business space?
Yes. One of the advantages of course, of quantitative investing is we can cover a lot of companies. And so that's certainly, there are thousands of companies in the global small cap universe. And we then divide up our investment process into what we call signal groups. And so we have a model that values a company of many dimensions. And then we have one that assesses its growth capability, one that assesses its quality of its business, and so the likelihood that business is going to continue or execute on its plans. And then we also have a model that's also very detailed, that assesses the current sentiment around that company. And when you put all these things together in a balanced way, you can build a portfolio that is both less expensive than the benchmark, but has companies that are growing faster than the benchmark, has businesses that operate with higher profitability from the benchmark, which is a proxy for quality, and has businesses that the market is currently favoring from a sentiment standpoint.
Okay, so how do you then approach risk management, especially in a volatile global market like we're seeing at the moment?
Yes, it has been a volatile market really since COVID and the first war, meaning the Ukraine-Russia war, and it's been one thing after another, and of course now AI is disrupting the market as well. From our standpoint, first and foremost, we don't want to take very much risk or any at all vis-a-vis the benchmark on areas we don't think we're good at forecasting. And so that starts with looking like a lot like the benchmark from a country and sector and industry perspective. Second, we don't want to be what we would call high or low beta, just simply meaning that we expect to outperform both in up markets and in down markets to protect a bit more than the benchmark. And then third, as a portfolio manager, I'm constantly on the lookout for some risks that could be common across lots of individual stocks, so maybe a theme. And so right now, for example, we're monitoring tariff risk, AI disruption risk, and unfortunately geopolitical risk as well. And ultimately, we're really just trying to force it into increasing the likelihood that our stock selection process, our quantitative process, can pick good companies among similar companies and not take unintended risks where we don't believe we have a skill or an edge in forecasting.
Okay, so you mentioned some of the risks that you're sort of keeping an eye out at the moment. What are some of the opportunities that you're seeing in the marketplace?
We are seeing opportunities in a couple of different areas in the marketplace. Indicate that we don't have vast differences between us and the benchmark on an industry or country basis, but we are picking up interesting individual stocks in the capital markets area, for example, in some European markets and in the United States. Also in the more kind of capital goods and construction materials markets in the United States and in Australia. And also starting to see a little bit of interest in European energy stocks as well. And so it is kind of a broad basis where we're finding interesting opportunities. And then finally, diversified financial services. Some of the companies that are navigating AI better than others, for example, in that space are quite interesting to us at the moment.
Okay, so how does Lazard differentiate itself from other fund managers in this space? And what would you say is your greatest strength as a fund manager?
I would say that we really differentiate ourselves, kind of going back to our philosophy, by delivering a very consistent return, high what we would call information ratio, meaning that we're getting compensated at a higher rate for the risks we are taking, and not being exposed to the swings in styles. So if you were to tell me next year is going to be a value year or a growth year, we would have a sort of an equal chance to outperform in both of those years, regardless of which style is in favor. And we've been finding that you put all this together in a very uncertain world, where you do see different sectors and industries, different styles, different countries having quite vastly different performance. By controlling for those risks and still being able to differ from the benchmark on a stock basis and add some excess return has really been resonating with investors.
Okay, can you share an example of a time when the fund's experienced a challenging period and how you've navigated through it to turn the performance around?
Yes. Yeah. One of the most challenging periods for us was when we did have a risk common across a lot of positions that we were not extremely well controlled for. We were aware of it, and that was going into the vaccine announcement during COVID. We were certainly exposed to what we would call the stay-at-home trade. Um, um, and we knew the vaccine was potentially coming. However, we didn't know the timing of that, and also importantly, didn't know the timing when consumers and customers of businesses would switch their consumption from essentially goods back into services. So when the vaccine was announced, the market was very excited, understandably so. But what they did was they sold everything that had worked and bought everything that hadn't worked in a very crude way, assuming that things were going to go right back to normal. We sort of stayed the course, let our process stay in the names that were still making money, and then we were able to get back that performance in the following quarters because, of course, what happened was the vaccine was not instantly rolled out to everyone. I was still working from my basement a full year after the vaccine announcement, for example, as well. And I think it's a good example of the type of market where we can certainly experience some short-term performance struggles when things that were extremely out of favor rapidly come back into favor. But eventually, the fundamentals and the earnings of those businesses were reasserted themselves, and we got that performance back on a relative basis.
Okay, well, how do you and your team stay ahead of market trends and maintain your conviction in your investment decisions?
What we really try to do is to improve our process over time. You can think of us as a team of engineers that are constantly trying to make our process better. And if I think about the broad arc of that improvement, we're really trying to do is understand more and more types of information that can help us predict either relative returns or risks. And if you think about where technology has been and is going, it's generally just getting more powerful in both how fast it can process things, how much data it can process, and the type of information it can process. And for us, it's really trying to stay ahead of that and incorporate as much information into our process as possible, always with the goal, of course, of producing consistent returns that we stay ahead of developments.
Okay. Well, Kurt, in your view, what makes a great portfolio manager in today's environment?
I think what makes a great quant portfolio manager, but I would imagine this is true of my fundamental colleagues as well, is to try to have an even keel. Even if you have a very good process in any given week, you're likely to have a couple of days where you underperform and maybe 3 days where you're outperformed during that week. And if you pay attention to kind of too much to short-term performance, you can get very stressed out about that, and a lot of it is noise. And so, generally it's folks who don't get too optimistic or too much hubris when things are going well, and don't get too down or too depressed when things aren't going well, because the equity markets are notoriously noisy, and even well-developed processes that do work will go through periods where they may struggle. And eventually, if you're doing everything right, you should be able to get that performance back.
Okay. Well, Kurt, we've covered a lot of ground today. Is there anything else you'd like to add?
Um, yeah, I think we've covered most of it. I do think that what makes a good quant portfolio manager, a good portfolio manager, probably also should make a good investor. And so I would urge clients to give their fund managers a bit of patience, especially if nothing has changed at those fund managers, and know that a good manager likely is still a good manager, even if they're going through a bit of underperformance. And I would encourage investors to do that with them as well. Generally, over time, equity markets do go up, but certainly they are volatile in doing so.
Okay. Well, Kurt, I appreciate you making the time to talk to us today.
Thank you very much for taking the time to speak with me as well.
Kurt, I appreciate you taking the time to talk with me today. It took us 3 goes to get this sorted. If you'd like to talk to Solace Financial regarding your current financial strategy and whether it's suitable for your goals and objectives, please reach out and contact me via our website or give our office a call to schedule an appointment. Thanks again for your time, Kurt. I really enjoyed learning more about Lazard Asset Management's systematic trading strategies and how they add value for clients.